So,
And last point, I know we're done. Last point, you said, Raoul, I heard you say before that he or she who has cash in a recession is king.
Correct. Because if we're right here, and you got cash, and we're going to see this big whoosh, and it probably means that the economy and asset prices, there's certain things it's going to set up for, right? We were talking off air about, okay, the opportunity to buy cryptocurrency into this sell-off. Yes. So, okay, let's go back and say, I'm going to go take you through a history lesson.
Good.
And then we'll get to today.
That's
and
macro.
I'll tell you why I'm concerned.
Yeah.
So why World War II? World War II was a fascinating period because, like COVID, the entire world had basically been stuck at home or been on battlefields. Everyone came back. There was no supply of commodities and goods. Global supply chains were broken, and everybody came back and started consuming again. And guess what? Inflation went up to 13% or something, maybe even higher. And that period was fascinating because interest rates went up, and the first thing that happened was the economy went straight back into recession, and rates and inflation went negative. Because it was a massive tightening of monetary conditions. You raised the cost of goods on people and didn't raise their salaries enough. People couldn't get the goods that they wanted, exactly like now, and everything collapsed. The next time we saw anything remotely like this was 1974. A lot of people tell you it's the 70s again, inflation. Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce all at the same time. It was the largest demand shock the world had ever seen. And we had a supply shock of this oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. 1974 was the Arab oil embargo. The price of oil tripled and interest rates went up. Inflation shot up. And the immediate effect was the economy went down the toilet. Almost do not pass go. The stock market fell 50%. And the ISM survey, which is a good guide to the business cycle, it's the Institute of Supply Managers survey. Anytime it crosses below 50, suggests the economy is getting weak. A recession comes at about 47. It hit 30, which was the lowest in all history. And it happened in a space of 4 months. It went from roughly where it is today, which is around 55, and went to the lowest level in 4 months, based on exactly the same kind of setup we've got now. Then the next one up is 1984. 1984, we saw an issue where global trade, there was a huge amount of trade disputes. The dollar was pretty strong, like it is now. Interest rates were going up, and inflation was high. And everybody was fearing, looking back and saying, oh, we don't want the early 80s, late 70s again, the inflation. So Volcker was tightening rates too much, and the economy collapsed. It didn't go to recession because the Fed quickly started cutting rates, but the dollar went up a lot more and created a lot more problems. We ended up with the Plaza Accord in 1985 when everybody had to stop the dollar going up from destroying the global economy.
Right.
So then the next time we see something similar, 2008. 2008, if you remember, the oil price was at $147. Inflation was 6%. The Fed had been cutting into that because the economy was imploding. 2018, exactly the same. Oil prices high, inflation high, the Fed were hiking rates, trying to tighten the balance sheet, and what happened is the economy rolled over really quickly again. Okay, so what's going on here? Why does this phenomena keep happening? Everyone extrapolates inflation out forever. What actually happens is that consumption falls because we've tightened monetary conditions. So tightening monetary conditions to ordinary people means the cost of your mortgage has gone up at the fastest pace in history. Over a 1 year period, mortgage rates have never risen this fast. So any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer. So you can't consume as much and you start not consuming other things. So we've got the setup that we've seen many times in the past. We've got the forward-looking indicators, this monetary tightening, suggesting we've got some real pain to come. Then the anecdotal evidence, we're seeing all the tech companies who were bulletproof laying off staff and giving earnings warnings because everybody can't raise prices enough. So their margins are falling and people have overextended. Amazon said, we've hired too many people. They're one of the biggest employers in the United States. Okay, this is not good. But the answer to higher prices is higher prices. And that's what's happened. And everybody's looking around you themselves saying, well, what's going to break when stuff like this happens? The market goes down, something's going to break. We're looking, what bank is it? What hedge fund is it? The actual answer is, it's the economy. The economy has just broken. And the Fed are going to have to pivot.
What are there key indicators we should be looking at and paying attention to?
I think I always say the bond market is the truth. The bond market, the job of bond market participants is two things only. What is the future rate of inflation and what's economic growth? Now in the stock market, it's like earnings and this and emotion and all of that. The bond market is simply two things. So they usually get it right. And the easiest way to look at it for most people is TLT. TLT is the bond ETF. If that starts rallying, which it's been doing strongly, before it was going down when the stock market was going down because everyone was fearing inflation. It's just switched. So bonds are now going up when the stock market goes down, which tells you the bond market's going, okay, enough's enough, guys. You've gone too far.
Is that why Harry Dent is yelling and screaming to buy treasuries?
Yeah, and I am too. It's the best trade in the world.
That's
interesting. It's the best trade in the world at this phase, the next 2 to 3 months. At the end of this phase, I think the Fed come with their cannons again. Whether it happens quickly or in 3 or 6 months' time, it's coming, and the markets will start to the Pavlovian response of the cavalry's coming. And then I think it's very positive for things like cryptocurrency, probably gold, and a few other things.
So
last point, I know we're done. Last point you said, Raoul, I heard you say before that he or she who has cash in a recession is king.
Correct. Because if we're right here, and you got cash, and we're going to see this big whoosh, and it probably means that the economy and asset prices, there's certain things it's going to set up for, right? We were talking off air about, okay, the opportunity to buy cryptocurrency into this sell-off. Yes, because it is the technology of the future. It also protects against this debasement. We will see, let's say, technology equities, things like genetic sciences and AI and all of this stuff that's coming. It's coming faster than we can ever imagine. Most of this stuff is down 80%. I mean, hell yes. This is what we're looking for. If you want to generate wealth, this is the time to step up.
Yeah, this is the best time.
And you might have the ability to own both commodity stocks because the supply issues are still around for a while. Commodity stocks and technology at the same time, which a lot of people think is weird. It's like you need to be one or the other, and they have this warfare over it. I think both will work quite well as a barbell strategy.